Let's talk about 2026. Because if you're looking at the markets, you've probably noticed the old rules just don't seem to apply anymore. So today, we're going to break down exactly what's happening and why this new reality is so incredibly different from what we've seen before. For the last few years, it felt like you could do no wrong, right? You could throw a dart at a board of assets, and chances are you'd hit a winner. That was the famous everything bubble. So the big question on everyone's mind is, are we still in it? And here's the thing. The answer is a pretty clear no. The party where everything goes up together is officially over. And what's replaced it is a much more fractured, much more selective market that, frankly, brings a whole new set of dangers to the table. To really get a handle on where we are now, we have to take a quick step back and remember what that everything bubble actually felt like. The whole post-2020 era was really defined by one simple theme: universal asset inflation. Back in 2021, a tidal wave of cash flooded the system, and it was a rising tide that lifted all boats. Stocks, crypto, real estate, you name it, it soared. But 2026, it's the complete opposite. We're now living in an age of valuation divergence, where some assets are hitting unbelievable new highs while others are just getting crushed. And this leads us to the single most important idea for understanding today's market: the great correlation break. That old comfortable idea that all assets kind of move together, well, you can pretty much throw that out the window. So, this brings us to that term, valuation divergence. What does it actually mean? Well, it's pretty simple. It just means the risk you're taking in the stock market is now fundamentally different from the risk in real estate, which is different from crypto, which is different from commodities. You can't just paint the entire market with one big brush anymore. So to make sense of this new fractured world, we're going to do a little ranking. We're going to line up the major asset classes along a spectrum, all the way from the most overvalued and dangerous down to the most undervalued. And coming in at number one, no surprise here, the absolute epicenter of risk in the current environment is the equity market. Its status? We're talking an extreme, historically massive bubble. And the numbers, they're pretty stark. The CAPE ratio, which is a great way to measure long-term valuation, is sitting at around 40. The historical average for the last century, it's 17. That puts us in the 99th percentile of all valuations in history. We're in the same neighborhood as the peak of the dot-com bubble. But here's the crucial twist. Unlike the year 2000, the giant tech companies of today are insanely profitable. So the risk isn't that they're going to go bust. The risk is that they are priced for absolute flawless perfection. Any tiny little disappointment, any slight miss on those sky-high growth numbers could be the pin that pops this thing. Okay, let's move on to our number two asset class, residential real estate. Now, this isn't your classic speculative bubble that's about to pop. It's something else entirely. We're calling it a frozen bubble. The national price-to-income ratio is at 5, meaning the average house costs 5 times the average income. Historically, that number has been way closer to 3.2. To put it simply, houses have become fundamentally unaffordable for the average person at today's interest rates. So the key takeaway here is that this isn't like the pre-2008 speculative frenzy. This is a mathematical ceiling. Prices have literally hit a wall because buyers just can't get the loans to push them any higher. The result? A market that isn't really crashing but is completely and utterly frozen solid. All right, now for number 3, commercial real estate. In this corner of the market, we have a bubble that isn't just threatening to pop, it is actively deflating as we speak. But it's really a tale of two completely different markets. On one side, you've got the office sector, which is in a full-blown crisis. Vacancy rates are through the roof, and there's this giant wall of debt that needs to be refinanced. But on the other side, the AI revolution has created an unbelievable boom for industrial space and data centers. They're thriving. It's the perfect example of that valuation divergence we keep talking about. Next up on our spectrum is cryptocurrency. And this is where that old everything bubble story truly, completely falls apart. What's its status? A bear market. While stocks are busy hitting all-time highs, crypto has been in a serious correction. I mean, you can see the split right here on this chart. The S&P 500 is pushing to new highs, while Bitcoin is down big. This is a massive break from how they've moved together in recent years, and it tells you that money is getting really picky. It's flowing into AI stocks and away from other risk assets. And finally, we get to the complete opposite end of our spectrum. At number 5, we have precious metals. In a world where almost everything feels stretched, this is the one major asset class that looks genuinely undervalued. You could almost call it the anti-bubble. And this single number is incredibly telling. The ratio of gold's price to the S&P 500 is just 0.44. Now, to put that in perspective, during past market panics, that ratio has soared to 1.5 or even higher. It basically means gold is historically cheap compared to stocks right now. So we've painted this picture of a really fractured landscape, right? You've got overvalued assets, correcting assets, and undervalued assets. But what happens when all of these have to exist together in the same financial system? Well, that leads us to a completely new kind of risk, a new kind of contagion.
Here it is. This is the entire 2026 landscape on a single slide. You've got your overvalued assets like stocks and housings sitting at the top. You've got the assets in correction, like crypto and commercial real estate, stuck in the middle. And at the very bottom, you've got the undervalued stuff, like precious metals. The market is clearly split in two. This brings us to the most important question of all. If we're not dealing with an everything bubble where it all collapses together, then what is the single biggest danger we're facing?
The real danger is a new type of domino effect. Here's how it works. It starts with a crash in the biggest bubble of them all, the stock market. That crash triggers a wave of margin calls, forcing investors to sell whatever they can, as fast as they can, just to raise cash. And what do they sell? Not their frozen real estate. They sell their most liquid assets, like gold and crypto, even if those assets are fundamentally strong. So a crash in one bubble can actually pull everything else down with it, not because of fundamentals, but because of pure forced selling. And that leaves us with the ultimate, critical question for 2026. In this strange new world of valuation divergence, if the biggest, most inflated bubble of all finally pops, where on earth does capital go to hide?